Hi, I'm Jimmy. In this video, we're going to look at the US economy. We're using a few different economic indicators to see if we can objectively gauge where the economy stands today. And hopefully, we can use this information to answer the question, do we invest now or do we wait for the stock market to crash again? Okay, so let's jump right in. So we're going to begin with some obviously negative points for the overall economy, and that's jobs. So this is a chart of initial jobless claims, and initial jobless claims tracks how many people file jobless claims for the first time. And I'm sure that it's obvious enough, but the reason that this is easily a negative point at this point right now is because this most recent jobless claims number was 778,000 new jobs filed. And yes, that's certainly better than the 7 million or so that were filed back when the coronavirus first hit, but that's almost quadruple what the numbers were at the start of 2020 before the coronavirus hit. And clearly the concern with initial jobless claims numbers going up is that it's very difficult for the economy to really start moving if a whole bunch of new people keep losing their jobs. How can the economy truly recover if new people keep losing their jobs? Okay, now to get a more complete look at the job situation, this is the U3 unemployment rate. And this tracks how many people are unemployed as a percentage of the total workforce. So how many people that are able to work and are looking for work are actually not working. This is that number. Now, I think it's also important to point out that this economic indicator comes out monthly, while the initial jobless claims comes out weekly. So there might be a slight lag to this economic indicator. But even with that in the back of our mind, I do think that there is something interesting when it comes to unemployment. And that is that, yes, the unemployment rate of 6.9% is not a good number. That's a bad thing. But the fact that the unemployment rate is in fact declining as it has been, coming off of at least off of the highs, well, this falling number must mean that there are more jobs coming back online. There are more jobs more people are getting jobs than are losing jobs that we saw in the initial jobless claims. So I think that overall that's a good thing. But the economy could really pick up a ton of speed if we could ever stop the bleeding, if they could ever stop the initial jobless claims number from being as high as they are. Well, I think that the economy would come back much, much stronger. But either way, over on our economic scorecard here, both initial jobless claims and unemployment are bearish points, since right now, initial jobless claims is clearly way too high, and the unemployment rate, although improving, is still too high, or still higher than it should be. Okay, simple enough. Now we've got some real estate economic indicators to consider. First, we have housing starts. This economic indicator tracks the amount of new houses being built. And as we can see, well, new houses being built have continued to increase over the past few years, and that's a good sign for the broader economy. And then, along the same notes, if we jump over to the average price of houses, well, according to the National Association of Realtors, once again, the average price of houses has been increasing. Again, a positive sign for the economy. And the most recent number here, well, that saw a nice pop on top of a good trend moving higher. So there was already a good trend, and then we saw an additional pop in recent numbers. So over on our scorecard, well, clearly these are going to be 2 points for the bulls, since they are both good signs for the overall economy. Now, we could make the case that both of those bulls are really just saying that real estate is doing good. And I suppose we could also say that the 2 bearish points that we have around jobs are really just saying that the employment situation is bad. And that's broadly true. We could easily do that, so we'll just call it a wash for now. Okay, now last month, when we did the same analysis, well, one economic indicator that we used was the Baltic Dry Index. And this is an economic indicator that tracks the cost of sending goods, mostly raw materials, via ship. And it did a great job of predicting when the economy was really getting in trouble at the start of COVID. So if we were watching this economic indicator back at that time period, well, we would have seen that there could be a serious problem. This was before the stock market tanked in the start of 2020. So from that perspective, this is a very useful economic indicator. But if we go back 10 years, well, look at how volatile this economic indicator really is. That being said, I'm not terribly sure how useful It really is. It's been all over the place. And yes, in the COVID situation, I think that it was very useful, but I'm not sure it's going to be very predictive for us going forward outside of unusual circumstances. With that being said, I think it makes sense to replace this one with something called CEO confidence. So the CEO confidence economic indicator it's basically a monthly survey of CEOs where they rate their confidence on the expectations of business conditions. The CEOs rate their confidence on a scale of 1 to 10. So what we end up with is the average. Now, this indicator is also a little bit volatile, not as volatile as the Baltic Dry Index is, but still somewhat volatile. So I think it makes sense to look at it strictly from a big picture perspective like we have here. By big picture, I mean over a long time period. And if we're curious how useful this economic indicator has been in the past, well, going up to the financial crisis, well, this line right here is when the peak of the stock market, the peak of the S&P 500 happened. So clearly leading up to that, this index was already falling. So again, if we were paying attention to nothing but this, well, we could have seen that things were getting a bit hairy, and that was while the stock market was going up, and then it tanked right around that time period. Now, when we look at where it is today, well, I think that it makes sense to give this point to the bulls, since overall it seems that CEO confidence is still fairly high. So over on our scorecard, we'll give a point to the bulls for this one. Okay, now we're shifting over to the manufacturing sector. This is the ISM Manufacturing indicator, and the key level here is 50. When the gray line is above 50, well, that tells us that the manufacturing sector is growing. Whenever it's below 50, that tells us the manufacturing sector is shrinking. And clearly that's a bad thing. So when we're considering where the ISM manufacturing sector is, ISM manufacturing indicator is today, well, it implies that we're seeing not just growth, but consistently increasing growth, at least off the bottom from COVID. So clearly this is a good sign, and we switch back to the scorecard, we got to give this point to the bulls as well. Okay, now we're moving over to consumer confidence. So last month, I actually had consumer confidence as a neutral point. Neutral point is where we give a point to the bulls and the bears. And I was actually super curious how consumer confidence would shake out once a vaccine was announced. Now, I know they haven't started distributing them yet, but once a vaccine was announced, I was curious what would happen to this economic indicator. And the news of at least Pfizer's vaccine had come out before this number was accounted for. This is a monthly number, so there might be a bit of a lag to it. But still, the fact that the number didn't move up at all, in fact, it had a slight pullback in the most recent number, I was a little bit surprised by that. With that being said, I'm actually a bit hesitant with my previous call of saying this was a neutral point because I assumed it was going to keep marching up. So I didn't think it was quite as negative. It had stopped falling at that point. But if it's just going to stay down at in this lower range, well, I'm a bit more concerned, and I think that it might make more sense to make this a bearish point. So back to the scorecard. Well, here I think it makes sense to give a negative point, which is a point for the bears, to consumer confidence. Okay, now the other change that we're making to this month's scorecard is last month we had the Federal Reserve indicator as one of our points to consider. Now, I think it makes sense for us to drop this point. One of the key reasons is that the Federal Reserve is not really an economic indicator. Yes, the Fed has a huge impact on the overall economy, and we could easily make the case that the Federal Reserve lowering interest rates are the reason that housing starts and even housing prices are doing as well as they are. Maybe if we wanted to, we could also say that CEO confidence is greatly impacted by what the Federal Reserve is doing. But from how do we quantify the impact of the Federal Reserve? Yes, they're lowering interest rates. That's a good thing for the overall economy. At least it's supposed to be. But they're also taking on more debt. That's a negative thing for the overall economy. I'm just not sure. Last time we had the Federal Reserve as a neutral point, I'm not sure I can think of a scenario where it's not going to be a neutral point. Almost everything that they do has positives and negatives to it. So I think it makes more sense to be aware of their impact, but not necessarily add that to the scorecard. So when we look at our scorecard in general, with the Federal Reserve dropped, now let's answer the question, does it make sense to invest now or wait for a crash? And I certainly think that there are good signs with the broader economy. Clearly, this is a positive sign. And I think that investing makes a lot of sense. But I'm super concerned personally with how high the stock market is right now. Now, I think that the most logical way to invest is either one, dollar cost averaging, which is where you consistently put in the same amount of money every month or whatever the time period is. I think that makes a ton of sense. No matter what happens with the stock market, just keep doing that if that's what we're doing. Beyond that, I think it makes more sense right now to wait for great investment opportunities. I don't think I personally will not be just throwing my money in the S&P 500 or something like that. I think that it's very possible the stock market pulls back and levels itself out because it seems very overvalued at this point. So if we can find great investment opportunities, good value, perhaps value pockets in the market, that's where I think we should be investing right now. Now, I recently did a video where I went through the PE ratio of the S&P 500, the Buffett indicator. I looked at the Shiller PE ratio to try to see how overvalued the stock market really is right now. Now, I plan on doing another one of those videos soon. I actually want to turn that more into a monthly series, a lot like this video is. So if you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.